So we're going to kind of wrap all the economic stuff and into the market. So I'm going to give you the punchline up front. What I'm going to hit over the next 15 minutes is the market's in pretty good shape. Earnings are hitting new highs. Valuation is actually okay. But underneath the surface, there is a dot-com-like bubble that is bursting as we speak. It's happening right now. That causes some risk, and we got to worry about the risks out there. But unlike 2000, it's creating a tremendous amount of opportunity. So that's where we are today. So let's hit what's going on in the world. And you've all heard we have the easiest job in the world. We have to figure out two things, and that's it. We have to figure out earnings and priced earnings. Earnings times priced earnings gets you price every single time. So let's hit the earnings part. This goes back to 1980. Earnings are up and to the right. Earnings are hitting a new high. The stock market's hitting a new high. Makes complete sense. And as Snoopy pointed out, the earnings growth has been a yawner. It's unusual to have it go right at trend line. Normally it spikes above and then it collapses. So we're not worried about a collapse because it's been so slow. So earnings up and to the right, hitting new highs, check. Now what's the other half of the equation? Valuation. You've all seen this, the rule of 20. One of our favorites is the most common sense thing in the world. And we're going to walk through it quickly. The red line is theoretically what the market should be trading. The blue line is actually what it is trading. So going back once again to 1980, we have 1980, bonds are at 10%. So rule of 20, 20 minus 10 gets you 10 times. So the market was trading at 10 times. As rates came down, the valuation went up. Made complete sense. We go to 2000. In 2000, the market was trading at 25 times. 25 times. 20 minus not much gets you 25. So we're already in trouble there. You could get 7% bonds in 2000. So 20 minus 7 gets you 13. Massively overvalued. So it was a rough ride. Then we had the bear market. Went back down to normal. Then we had the Great Recession. Then the blue line went below the red line, which is good. We like blue below red. And then we spent the last 10 years benefiting from that. We talk about the alligator jaws. The alligator jaws closed the good way. So right there we have earnings hitting new highs, valuation slightly under, about 5% undervalued. So you would think we'd all be in a pretty good mood. You would think the news would be in great shape. Everybody talking about how much fun we're having. But as Logan was saying, people are pretty scared. Every time you turn on TV, it's the next recession, the next bear market, the next this. And we get the fact that they have to sell things, so they're trying to scare us. So Stephanie found a cute little cartoon kind of highlighting this. This is the pilot comes on, says there's going to be a little turbulence. Please fasten your seatbelts. The guy in the middle says, we're going to die. The guy next to him says, he's a financial reporter. So we get what they have to do. But as we just discussed, things look pretty good. So why are we talking about this underneath the surface, this dot-com-like bubble going on? So this is the best slide we could find to illustrate what we're saying. So this is going back, looking at the most expensive stocks in the market compared to the least expensive stocks in the market. And obviously there's always going to be a spread, because one's most expensive, this is least. And it tends to run about 10 multiples apart. Then we had 2000. The most expensive stocks went up to 35 times. Do you remember the dot-coms? Trees were going to grow to the sky. Earnings don't matter. This is the new world. Then the other group just stayed at 12, 13 times. Then, of course, trees didn't grow to the sky. And then the valuations got back to their normal levels. And then something started happening about 2 or 3 years ago. So then the most expensive started to take off again, and valuation really didn't matter. So now we're up to 28 times for the most expensive, and the lower under 10. So we had this spread widen again. The big difference here is back in 2000, you remember the 7% bonds? So the market should have been trading at 13. So the least expensive were at 13. The least expensive were fairly valued. The most expensive were massively overvalued. So guess what? We had a major bear market to correct the problem. Today's a totally different scenario. What are bonds today? 2%. So the market should be trading at 18 times. So The overvalued, that's a risk. That's still a risk. But the undervalued is a tremendous opportunity. We didn't have that in 2000. We didn't have this opportunity. So it's possible, and the way we're looking at the world, is that 18 is going to hold. But we have this great rotation. The most expensive come down to earth. The least expensive start to go up. So when you're reading the headlines, it looks boring, but underneath there's this massive rotation. And that's kind of where our process has been pushing us. And for 2 years, it didn't really work, but lately it's been working tremendously. So we could see a lot of movement underneath the surface without much on top. So who are, you would think, let's go here. We don't call them dot-coms anymore. Now they're called unicorns. Has anybody heard about unicorns? Not the mythical animal. These unicorns are startup companies that have $1 billion in valuation or more. 5 years ago, they were hard to find, thus the term unicorn. Now there's hundreds of them, hundreds of these unicorns running around. And so give me a list of some of the unicorns of today. Everybody's heard of Wayfair, Uber, and Lyft. All losing money, billions of dollars. WeWork is my favorite. So if you haven't read about WeWork, please go home tonight and read about it, because a movie will be coming out, and it will be fabulous, because it is just the best story ever. So WeWork is an office-based company that said they were a tech company, and they got this Japanese private equity firm to give them money in January of this year, so 11 months ago, and they valued it at $50 billion with a B. $50 billion, and they're bleeding cash, losing money. So then, to exit the private equity, they came to the public market and said, hey, you know what? We're going to sell it to you. We read this stuff and said, this isn't worth 50. It may be worth 10. So they said, 10's not working for us. We need 50. And they pulled the IPO. Now there are people saying they might be out of business in 12 months. So they went from 50 billion to potentially out of business in 12 months. The beauty of that, especially for Argent, is now people are looking at the other unicorns going, hey, wait a minute. When are you going to start making money? So this valuation thing that didn't matter for years and that big old gap, now people are saying, I'm worried. Wayfair's down 50% since they pulled the WeWork IPO, because Wayfair doesn't have a plan to make money just yet. So we're looking at this saying, these unicorns are going on. We've seen this. The dot-com bubble was not that long ago. Surely we're not doing it again, which apparently we are. Have we not learned our lesson? So let's go to the opportunity side of this. So another similarity to 2000. This is a spread on valuation between cyclical stocks and defensive stocks. So cyclical stocks are companies like United Rental. They rent construction equipment like bobcats and scissor lifts and stuff that's tied to the economy that people are worried about. Defensives, Procter & Gamble, Ameren UE. You're going to pay your light bills no matter what. So what people are willing to pay for the defensives is a lot, and they're just not touching these cyclicals. Because the last time we had this spread was coincidentally 2000 with the dot-com bubble. So with the unicorn money coming out, we're starting to see a little turn up on people walking into the United Rentals of the world who are trading at 6 times earnings, who have grown for 10 years. People are starting to hit those. So we could see this massive rotation we were talking about, that these cyclicals will start to benefit. And that's where our process has been kind of guiding us for the last couple of years. And while it was out of sync, it's starting to really show some benefits. So let's hit, while we're on the process, you all know our change-based investment process. Identify change, evaluate change, verify change, and quantify change. Pulling all of those together in a very selective, disciplined way has been our secret sauce for 21 years. The one part of the 4 building blocks that hasn't been working was the valuation part. Doesn't mean you abandon it. It just means it wasn't working like in 99 and 2000. It wasn't working. Sticking to it has been very beneficial, especially of late, and we think we're very well positioned going forward on that. So a couple of examples. People love names, so we're going to throw 3 up there. This name, since it's the holiday season, we figured we'd bring up a retailer. Target. Everybody knows Target. This is the 3rd time we brought up Target. The first time we brought it up was 2 years ago. And the reason was because it was a new name. Then we brought it up last year because it was a stinker. It wasn't doing much for us. It was actually in our loser camp. And then this year, they've been executing on the strategy. It's been one of the more fun stocks to talk about in the last 12 months. And the two things on this slide, number one, is the process identified this when it wasn't popular. In fact, it was very controversial because when we bought it, people called and said, have you heard of this thing called Amazon? And we're like, yeah, we've heard of it. But the process is saying, take a look at it. Then last year, it was trying our patience. But it was still fitting the process, so we said, hey, trust the process, have the patience, it takes a while, and then fortunately everybody in this room has been rewarded by keeping the patience. So trust the process and patience are two key variables. One of our new names is a local company. We have no idea how it's going to turn out. Centene, big company, been growing. They have a huge acquisition. They just got approval on 2 states yesterday. It could happen at the beginning of next year. We bought them. Of course, it promptly went down, and it's fighting its way back. So we don't know how that's going to turn out. But do you remember that spread between the most expensive and least expensive? They're in that least expensive camp. So if they can pull off this acquisition, hit all this stuff, it could be a fun shot or a fun stock, but we'll see how it turns out. And the last one is an update on one we talked about in June, which was a new purchase at the beginning of the year, which was Disney. Disney, we view Disney as kind of the Target of the media world. So Target had the stores, and they figured out online, so now they have the best of both worlds. Disney has the content. They didn't have the Netflix distribution, so now they do. So now they're going to marry the best of both worlds. So Disney Plus is the new thing that's happened since last time we got together. Disney Plus was launched a couple weeks ago, and the subscriptions are 2 to 3 times what people thought. I know my girls called me immediately like, hey, are we getting Disney Plus? I'm like, I already bought it. We own the stock. I'm buying it. And so Christmas is coming up, so stocking stuffers, Disney Plus is a great thing for your kids or grandchildren. So please go ahead. It'd be great for the portfolio. It's a win-win for everybody out there. But it's still early on, and we'll see how that battle goes out. So the summary is the market looks okay. E and PE look fine. Underneath, there could be a massive rotation that could be a lot of fun and a lot of risk, depending on where you are. And then the last part is trust the process. And the beauty of the process is not only works in large cap land, but it works in small cap land, works in mid cap land.